these banks are going to be less willing and able to lend, and that will impact the real economy. Welcome to Key Points for April. This month, our take on the current banking challenges and why we don't think this will lead to a systemic banking crisis. We'll look at the much tighter lending standards and what this means for the underlying economy. And of course, as always, we'll look at the financial markets and the resilience they've shown so far. Can this be maintained in the second quarter? Now, turning to the first point, as you're all fully aware, there's been significant stresses in the banking system on both sides of the Atlantic. The US bank index has been down around about 20% in the first quarter of this year, reflecting these challenges. Now, we don't think this is going to be a systemic banking crisis, and there are a number of reasons for that. Things have changed appreciably in the last 16 years since we did have a systemic crisis. When we look at the capital and liquidity ratios of these banks, they're in very much better shape than they were back then. We look at the quality of assets on their balance sheets, and there has also been a meaningful improvement there. Oversight has improved, and we've got greater visibility into the workings and exposures of these banks, and that again leads to better confidence and greater understanding. But there's still an Achilles heel of the banks, and that is they're still very much dependent on confidence. Once you start to see deposit flight or counterparty confidence be undermined, even a very well capitalized and established bank such as Credit Suisse can find that the business comes under pressure very quickly. Now, we're encouraged by the circuit breakers that were put in place by the policymakers. That has led to a containment of a lot of these issues. We haven't seen contagion throughout the sector and spilling into other sectors as we had back in 2007 and 2008. So that's clearly encouraging. But it does mean that these banks are going to be less willing and able to lend, and that will impact the real economy, which takes us to the second point. Financial conditions have tightened appreciably over the last 12 months. Recently, the central banks, in order to tackle the banking issues, they've tried to separate the circuit breakers and the support they give to the banks from their interest rate hikes that they've been putting in place. Inflation is still challenging at the core level. Just last week, we saw the inflation reading for Europe, the core reading, come out at 5.7% year on year. That's the highest this cycle. And that has again encouraged the banks to continue to move interest rates higher. And we saw another round of that in the last week or so. But it means that rates are now meaningfully higher than they were a year ago. The Federal Reserve has moved rates up 475 basis points, 4.75% in the last 12 months alone. And of course, that's by design, intending to slow the economy to take off some of the inflationary pressures. But it can also lead to unintended consequences. We've all become accustomed to being rates for interest rates to be low or even negative for the last decade. So when we get these massive move up in rates, of course it means that some business models are going to fail and bankruptcies are going to pick up. And indeed, that's what we've been seeing. In the case of Europe, we are seeing defaults rise. And looking at the United States as well, we've seen defaults in terms of volumes in the first quarter of this year be greater than the whole of 2021 and 2022 combined. Admittedly, these were very low levels, but it shows you there are stresses in the system, and that's something that we think is going to, again, slow quite appreciably the pace of the economies going forward, and why we still feel very comfortable with believing there will be a US recession in the second half of this year. Now, how have the financial markets responded to all of this? Well, different asset classes are pricing in different outcomes from the economy. In terms of the equity markets, they've performed very well. There has been rotation from the banks, as an example, in towards the large cap tech companies. So for example, while the bank stocks were down about 19-20% in Q1, the tech-heavy NASDAQ was actually up 17%. So equity is still doing well, the rotation within them. However, we don't believe they fully reflect the underlying economic fundamentals. Where we're expecting, of course, a slowdown, where we're expecting margins and earnings to be impacted in the months ahead. Credit markets have recently shown more volatility. Spreads have widened. There are pockets of stress beginning to come into the system there. And we still think there's a vulnerability as these bankruptcies and defaults pick up. What's interesting is on the bond market, because bond yields have come down across the key markets, reflecting a slower growth dynamic going forward, the risk of recession, and also market pricing of future policy rates implies that actually we're going to see rate cuts in the second half of the year following the last 12 months of massive rate hikes. And this is a scenario that we are more inclined to buy into. We do believe, as I said, that actually as growth slows, people will look for more defensive plays, and actually bond yields are likely to fall further, whereas the risk assets of credit and equities are more at risk in the short to medium term. But remember, as always, you can read the full report on zurich.com/MSME.